So, crowdfunding. So today I'm going to be talking about crowdfunding. So what is crowdfunding? Crowdfunding is a way for businesses to raise money, and it works through individuals or organizations who decide to invest or donate to crowdfunding projects in return for a potential profit or reward. So let me walk you through this a little bit. So if you don't know me already, in my free time, I like to smoke quite a bit of weed. And as most dealers do not accept card payments, I had to find a way to get cash out without commissions. Because last year for the pandemic, I went home and I've got a UK bank account. So I was looking to find a card which would allow me to not pay any commissions or fees, and also without my mum to see it because she checks my bank account. So for those of you who don't know it, Curve is a banking platform which allows you to have more cards and account into one single smart card and an app, and also allows you to track your expenses on a monthly base across different cards. So this allows me to not bring my wallet, which is good. Then a few weeks ago, I received this email straight from Curve, and as I'm currently educating myself on the financial world, and I strongly believe in the company, this email took my attention because I wasn't quite sure why a company like Curve would crowdfund and ask their customers for investments. So, why would a company crowdfund? So a company would crowdfund because they want to grow faster than they can afford without asking banks for loans, which is a lot riskier than just an investment for your customers. If I take the example from Curve, this is one of them. And as you can see, the 2019 and 2021 investment crowdfunding got them over 13 million pounds just for customers who wanted to invest in the company. So, as you may know, in LPIG, we look mostly at publicly traded companies because, and crowdfunding is not a way, it's a form of private equity, which means that company usually asks their customers to invest in the company. So, the difference between a private and a publicly traded company is that the shares of a public company can be traded on the stock exchange. Meanwhile, the ones of a private company cannot do the same thing. It's a lot harder to get rid of them. So, I'll tell you an example here, which is Brewdog. Brewdog is a brewing company from Scotland. We just started to produce beers, then to start opening pubs around Scotland, and also to then get more around the UK. So the main reason why they decided to do this campaign right here that you see on the screen, called Equity for Punks, is because they say they wanted their customers to become part of the company and to reduce the gap between customers and owners. This way, they would get money from their customers to fund their growth and so to have more money to get into the company. So one example is that they just made a fundraiser, crowdfunding last year about to fund their growth in Berlin, Brisbane, and Columbus. So they've expanded their business a lot, and they managed to open a rooftop in Las Vegas with the investments and with all their growth over the years. So this is like investing in a private company is a really risky investment because you don't know when or if you'll get the money back. And also, even if that happens, it could happen in a matter of 20 years. So you can't really predict what's going to happen with the money you've just invested. But at the same time, it could become a good investment because if it pays off, it could pay off big. The three pillars that we usually consider in LPAG are the numbers, so the annual report in this case, which for a private company is really hard to find because they're not asked to share their earnings or whatever goes on in their company. So it's really hard to find the numbers. The second thing is the competitive advantage. And if we take the example of Curve, the competitive advantage is on their side because there are not many other companies who can offer the same service as they're offering. And then there's the management of the company, which in the same way as for the numbers is quite hard to find because they do not really want to share too much of their company if they're not publicly traded. So the main question here is there a point in investing in a private company? Because it's a very risky investment and a really long-term one. So you don't know when or if it will pay off. But I've taken into account the potential risks, and as risk is my middle name, I decided to put a little bit of my money into it. Does anyone have any questions?